I am going to make the case that an investment on the S&P 500 is likely to do terrible over the next decade. I am going to be quoting from investors such as Terry Smith, Mohnish Pabrai, and Howard Marks. Then, finally, I will be covering what I am doing if the S&P is likely to do terrible. First, let's hear from Terry Smith, where they answer a question regarding Google, Amazon, Meta, and Microsoft's spending, and currently these four companies make up 16.3% of the S&P 500.
Now this one's quite pertinent to your presentation. This one comes from Wei Chen Ding. I love this question actually. Do you have any concerns about cloud providers such as Microsoft and Alphabet, both among your top 10 holdings, heavily investing in infrastructure? Could this shift indicate a transition from an asset light to an asset heavy business model with returns on these infrastructure investments being less certain?
So I think the short answer to that question is yes. One thing that we always try to do, as you know, is to, rather than, as Terry says, hand waving, arm waving, is to put up some numbers. So you can see that back in 2018, we picked 2018 as a start because it was a kind of unremarkable period, followed by a few years of unremarkable growth. So 64 billion for Alphabet, Amazon, Meta, and Microsoft combined in 2018. 69 billion, now a very modest increase in 2019, then it starts getting going in 2020. We are in 2024, we were at nearly 210 billion, and in 2026, we are forecast to be at 281 billion. So you also, another thing is that this is capital expenditure. You might have seen a headline the other day that in response to, as a result of Tim Cook going to the White House to see President Trump, that Apple came out and said it would spend $500 billion in the US over the next 4 years. Not much of that will actually be in CapEx relative to the rest of them. So these are huge amounts of spending, and we think there are three possible outcomes. The first is that it will all work out very quickly, that these companies will make the kind of returns on this expenditure which will sort of justify this spending pretty quickly. The second is that they will cut back, which won't be good for companies like Nvidia, which are, and the data center companies which are supplying them. But as Terry said, they are very well financed, so they can keep going for a long time. And the third is that they will indeed keep going, which inevitably will, I think, put a bit of a dampener on returns.
But we need to see some very big revenue and profit numbers that relate to this. So in addition to what they are already doing, they need to get us and other customers to pay for the AI. This is basically putting into supply to supply an adequate return on these kind of numbers. And as you can see, in a single year here, we're talking about 281 billion. So you needed probably to get somewhere like 100 billion of cash flow left over after you've paid for everything, in addition to what you've got already. So it's a very, very big mountain to climb.
And also, and remember, this is just CapEx. This is not like hiring the tens and tens of thousands of data engineers that they will be doing, all the R&D that they'll be doing. So the numbers that they require to justify this are...
I mean, if we had to guess, and we don't like guessing much, but if we had to guess, it will probably go through something which will echo what went on in the dot-com, which is, no, they won't get sufficient revenues and sufficient cash flows coming through, and there will be a bit of a disaster for a period, and everybody will run around saying this will never work. And then, of course, somewhere amongst the rubble will be great opportunity, because it will eventually, but probably not on the first outing, if it's anything like history.
Before going over to hear from what Mr. Pabrai had to say for the S&P, here is another clip of Terry Smith explaining why his fund has sold out of Apple. Apple is another company that is making 6.76% of the S&P 500, so with this addition, the total is now up to 23%.
And we sold Apple. When we bought Apple, it was on about 18 times earnings. It was trading on a rating lower than the S&P. So don't think we can go badly wrong with this business. We correctly foresaw that it was going to have a number of reporting periods of poor sales. So we only bought a 1% stake to begin with. We're going to get another couple of goes at this to buy some cheaper stock. We were absolutely right about the poor sales, and the share price doubled. And we still can't figure it out, frankly. Apple's sales growth for the last two full financial years is 0. Down 2% one year and up 2% the other year. And neither of us can figure out what's going on here. We think that if any of our other major technology companies had produced flat sales for 2 years, Microsoft, Meta, Nvidia, although we don't own it, Alphabet, it would be a disaster for them. So they seem to have a force field around them that protects them from this. But we do know we weren't going to buy any more on that basis. That we've been right about relatively poor sales, and the share price and rating had doubled. It's time, are we going to go up to our normal sort of holding, or are we out? We're out.
Now, as you can see, Terry Smith has his doubts regarding the high flyers on the S&P 500. Now, let's hear from Mohnish Pabrai, where he not only talked about the index overall, but more specifically about Nvidia, which makes up another 6% of the S&P 500. This is a longer clip, but I totally suggest watching the whole part.
I want to tell you about a visit I made to Microsoft headquarters in early 2000. I think this was about January 2000. There was a very early employee at Microsoft, Vijay Vashi. Some of you may have heard of him. And a wonderful guy. And Vijay was a very early investor in my fund. And he basically said, look, Mohnish, if you're ever in Seattle, I can introduce you to a bunch of current and former Microsoft people who may have an interest in investing in your fund, And I said, Vijay, what a coincidence. I'm going to be in Seattle in 2 days. And he said, oh, that's great. So I met Vijay. We went to Microsoft headquarters and he took me to a bunch of different offices and introduced me to a bunch of people at Microsoft, including I met Satya. He had a head full of hair at that time. And a bunch of wonderful, some of you guys might know Soma and so on. And so I met some wonderful, great people at that trip. And I was asked this question. Actually, I wasn't even asked this question. I actually gave my perspective. I told the Microsoft people and the ex-Microsoft people I met at that time, I said, look, when you're in Microsoft at this time, your livelihood comes from Microsoft. Most of your net worth, excluding your residence, is in Microsoft stock. And I said, it's a terrible investment. And it's going to play out really badly for you. And they told me, look, Mohnish, you are a value guy. You don't understand these things. You don't understand tech. You have no idea about this company. This is one of the best businesses that has ever been put forward on the face of this earth. I said, yes, but you're going to have a horrible ride. And of course, they all thought I was stupid and they didn't do anything. And if you look at the Microsoft stock performance from 2000 to about 2012, it was a terrible ride. I mean, at one point you lost like 60, 70%, unrealized loss, hopefully, if they didn't sell, but it would have been a very difficult ride to hold on. And it wasn't because they were wrong about the future prospects of the business. They were absolutely right. Microsoft was a great company then and it's a great company today. The S&P 500, it's not just me, but a lot of people say that, say, in the next 10 or 15 years, if you have an expectation that you're going to get more than 3 to 5% a year from the S&P 500, I would like to take the other side of the bet on that with you. So I think the odds that the S&P delivers over 5% returns a year for the next 10 or 15 years approximates zero. This is why I was asking and saying at the beginning that, the Magnificent Five or the Magnificent Seven, tell me those cash flows. Just run an exercise on your own. Look at the value of the businesses. If Nvidia is valued at 3 or 3.5 trillion, the cash flows need to be in the range of 2 or 3 or 400 billion in a relatively short period. Because as I go further out in the years, then I have to discount it. So when is Nvidia going to deliver single year, 500 billion cash flow? Okay, 700 billion cash flow. Because if I'm putting out 3.5 trillion, let's say I have a family fortune of 10 trillion and I buy the whole of Nvidia, 3.5 trillion. If I'm putting out 3.5 trillion, I want 7-8 trillion out of it, right? I want to double my money in a few years. How am I going to get 7-8 trillion? The only way I get 7-8 trillion is somehow there's like that much in cash flows that comes in the next 15, 20 years, discounted back, which means the cash flows need to be like 15 trillion or something. To get my 7 trillion, I need 15 trillion in cash flow. Show me how they're coming and which year, what cash flows are coming. And I just think that the math on that is hard. I mean, to me, it just goes into a too hard pile. So Warren Buffett increasing his cash position, he's publicly stated that he thinks that the corporate tax rates are at a record low rate right now. One of the reasons he's given for reducing the stakes is to basically realize the gain while tax rates are low. But I think he clearly understands that this 3 to 5% is not lost on him. Between us girls, it's not going to be 5%. It's going to be less than 3%. Okay. And Warren actually kicks himself for not being aggressive enough during the financial crisis. He's also said the fact that we will have a dislocation in the market in the next 100 years is 100%. The odds that we will have a significant dislocation in the market in the next 10 years is quite high. Not 100%, but quite high. So his perspective is, okay, man, one dislocation that's possible for Berkshire to have is when Warren passes away. Okay, they stop buying the stock. They're not even buying their own stock now because they think it's too richly priced. So it would not be imprudent to read into Buffett's large cash position that the future is not that great for a lot of the high flyers and even other flyers in the S&P. So a lot of you have a lot of money in Microsoft. I think the world of the company. I think it's a fantastic business. If I owned Microsoft today, I would be more bullish on it than I was in 2000. So I wouldn't want to sell. I mean, I don't like to sell things which are great, which is what I was asking people in 2000. But 2000, it was just egregious. It was just 10 billion or less in cash flows on a 600, 700 billion market cap. It was like a trailing P of 70 or something. Satya is fantastic. The team is fantastic. But I would say that probably having at least half your assets outside Microsoft isn't the worst thing in the world you could do.
Now, all this doesn't mean that I expect the S&P index to halve in the next month and stay there. But if you are a long-term investor, the returns for the next decade will differ a lot from the returns of the previous decade. The index is not going to be magically averaging 10% a year returns for every decade. Here is a chart of the index between 2000 and 2010. You had been invested for a decade and you were down 22%, not adjusted for dividends. So why do they happen? It is a very simple reason. If you invest when the stocks have been doing bad for a long time, like the early 2010s, where the prior decade had two separate financial crises, you are likely to do very well, because you have paid a very good price for what you are getting. Now, let me read a couple parts from one of the most recent memos from Howard Marks. According to past data, from PE ratios like today's, the S&P has historically produced 10-year returns averaging between -2% and 2% per year. And some investment banks have expressed expectations that are similarly in the low to mid-single digits. On January 27th, an article on the front page of the Wall Street Journal said the following: stocks haven't looked this unattractive by at least one measure since the aftermath of the dot-com era. And this chart shows the S&P 500 forward PE ratios and subsequent 10-year returns. As you can see, the lower multiple you pay, the higher the returns are for the next 10 years. In 2011, you could have paid as low as a 13 trailing PE ratio for the S&P 500, and your returns, according to this chart, would have been in the mid-teens range. The current PE of the index is around 20 for the forward PE, and the trailing PE is 28. So at the best case, you are going to be getting a low single-digit returns for the upcoming decade. Finally, let me tell you what I am doing. First of all, I am not a fund manager. I have very limited capital, so I am free to invest in basically anything since size won't be a problem for me. Warren Buffett hoards cash simply because when he wants to invest in a company, that said company needs to have hundreds of billions of dollars in market cap to be able to allow a big investor like Warren Buffett to get in. Here, let's listen from Buffett himself from the 2019 meeting.
My name is John Durso, and I'm from New York. Mr. Buffett, you've said that you could return 50% per annum if you were managing a $1 million portfolio. What type of strategy would you use? Would you invest in cigar butts, i.e. average businesses at very cheap prices, or would it be some type of arbitrage strategy? Thank you.
It might well be the arbitrage strategy, but in a very different, perhaps, way than customary arbitrage is thought of it. One way or another, I can assure you, if Charlie was working with $1 million or I was working with $1 million, we would find a way to make that with essentially no risk, not using a lot of leverage or anything of the sort. But you change the 1 million to 100 million, and that 50 goes down like a rock. There are little fringe inefficiencies that people don't spot, And you do get opportunities occasionally to do, but they don't really have any applicability to Berkshire. So, Charlie?
Well, I agree totally. It's just what you used to say that large amounts of money, they develop their own anchors.
Yeah.
It gets harder and harder. I've just seen genius after genius with a great record, and pretty soon they got 30 billion and 2 floors of young men, and away goes the good record. It's just the way it works.
But
It's
Charlie,
hard as the money goes up.
when Charlie was a lawyer, initially, I mean, you were developing a couple of real estate projects. Or, I mean, you find, if you really want to make $1 million or 50% on $1 million, and you're willing to work at it, and you'll find that's doable, but it just has no applicability to managing huge sums. I wish it did, but it doesn't.
Yeah, Lee Lu, using nothing but the float on his student loans, had $1 million practically shortly after he graduated as a total scholarship student. He found just a few things to do.
Yeah.
And did them.
Okay, station 10.
So as you can see, if you are working on lower sums, it is much easier to compound them at much higher rates. You just need to look at the microcap companies, small cap companies, and even the international stocks. There are 2 problems with them big companies. One of them is they are priced way more efficiently. And the second one is when they are mispriced, it doesn't stay mispriced for long. You could have bought Meta under $200 per share. And spoiler alert, I did buy Meta under $200 per share. But that's not going to be a reliable option for the companies that big. They are going to be either correctly priced or overpriced. So what I am doing, if you look at my portfolio, is I am 95% invested in Turkey, which is where I am from. And 85% of my portfolio is invested in just one company. If you want to look at my returns, last year I had 104% returns, which is in USD. I am not using lira here. That is the real rate in USD. And I publicly stated my positions throughout the year, so you can just trust the figures. I cover the companies I am invested in Turkey on my Patreon. You can check it out and subscribe. The link is in the description. Even if you don't want to subscribe, all I am doing there is working on the public data of the companies that they release. You can just do that from CUP or the company's investor relations page as well. Thank you for listening all the way. If you liked the video, please leave a like and subscribe. Thank you again, and I'll see you in the next one. Bye.